Hi folks, welcome to another clip here on my YouTube channel. As always, before we start with the topic, I would like to invite you to leave some thumbs up for that clip. And of course, on top of that, you see that red button here at the YouTube platform. Just have a click, it's very easy, and you'll be a member of this channel. Very much appreciated if you do so. Alright, today's topic will be Euro-US dollar, something like an update on that kind of a situation we find with a lot of information from the Federal Reserve and on top from the ECB. Before we get into fundamentals, let's check out the chart technical picture right now. Alright folks, just a short chart technical picture. You see the usual chart from the 123.49 high. That's the 100% fib, so the long-term high from January 6, 21, going down to this last low here we see from 28th of January 22 at the level of 111.20. So these two levels here, a combination, the usual fib retracements being produced by the chart technical platform. In that case here, the guidance platform, as you see that one here on top. You see the 38.2 at 115.89, so way above that neckline. You see with a green one here. And you see the 114.10, which is the 23.6 fib, which already been tested and been back. Just because of the reason of this kind of happening the last trading hours in the Wall Street, in the last, let's say, 3 to 4 hours with that crisis level regarding Ukraine, Russia and NATO, USA, which lead to the strength of the US dollar. So the Greenback as a world reserve currency got some repatriations, I guess, and that went down south, way south in direction of the close here at 113.46. So you see that a green arrow showing, still showing that kind of a neckline as a possible target to the upside for the bulls, and that red one still at the target for the 111.20 for the bears, just retesting that level of the long-term low we saw here in the last 2 years. All right. A couple of fib retracements been produced by the platform that way because you use the 111.20 as a 100% and the last high here of 114.94.9 as a 0%. So you got to change that in direction, and you see a couple of projections to the downside as well. Right here, the 109.768 as a 138.2 projection, fib projection, and a 108.83, 108.883 as a 161.80 projection to the south. So that's the possible next targets here for the bears, just regarding more US dollar strength to come in case we see more trouble ahead in the next weeks. Especially important, nothing you see around all this kind of chart technical stuff, because all these facts are tremendously important. You see that US, NATO, Russia, Ukraine stuff. On top of that, you see all that kind of inflation stuff. On top of that, you see the different yields. You all see that from the facts, on the fundamental facts, but you don't see that in the chart. So that's very important, as it simply combines chart technical analysis with a lot of fundamental stuff. The fundamental stuff we are going to talk about right now. All right, some fundamentals. First of all, very important, we got to check a couple of facts which could melt, which have to be seen in combination. First thing is, of course, the rate hike scenario in the US in comparison with the rate hike scenario in the Eurozone. Second, the yields from the bond market, so the bond yields regarding, for example, US Treasuries, German bonds, Italian BTPs, French OATs. Third, the inflation data, the data from the US, so the CPI data from the BLS, and not to forget the data from the Eurozone, or let's say the brand new data from Germany. So 3 facts or 3 news cocktails which have to be seen together in combination. It's something like you put into a big soup. It's not
one ingredient. It's more, far more. All right. First of all, the rate hike scenario. If you're interested, check out what is the possible rate into the foreseeable future, into the next month to come, until the end of the year, or possibly the next 12 to 18 months. Like you know, I use that kind of Fed Watch tool. So you see probabilities, market probabilities, and you see probabilities of 70% for the March 16 meeting of a target rate between 0.5 to 0.75%. That would be a huge step, and that is something like a 50 basis points step at one meeting. Very rare. Usually 25 basis points at a meeting, and possibly the next 25 in the next 3 months after that, usually. But the current inflation rate, of course, scares the out of some central bankers, I guess. So possibly they possibly start hiking with a fat number. Could be. It would not be a total surprise. From a more comfy situation for the markets, the financial markets, I'm speaking about financial markets regarding the stock markets, for example, it would be a disaster to see something like a so fat move up the road and very fast move until the end of the year of way above 1%. I think it would kill the financial markets. I think that would kill the stock markets for some time. Especially tech sectors, growth sector stocks. Okay, from the current perspective at the Fed Watch tool, you see a probability going down in direction of the year 2023. They already put up dates for the year 2023, for example, for July 23, and just check it out. It is way above 50% probability that we see target rates around 2.25% or 2.5%. So that's what is printed right now. This is something like, if you just count up a couple of rate decisions, which are from the current perspective into a direction of 23, you would see something like a rate hike every second meeting, or a rate hike every meeting of 25 basis points, and we will end up at a certain level. Crazy, absolutely crazy. In the current financial conditions of the United States, for example, it simply, in my just point of view, it simply would kill the market. And on top of that, planning the kind of a reducing of the Fed balance sheet. So just in combination, I think that could not happen that fast that everybody is anticipating. Again, no wealth advice, nothing to draw you into some securities to buy and sell some stuff. It's just an opinion, it's just an information. So that is the point with the Fed projections, with the FOMC projections. So the Fed Watch tool. With the Fed Watch tool, probabilities. That's the correct word. Now checking out inflation data. Inflation data, looking at, for example, the 7.5% in the US, a record number, a crazy number, not seen more than 40 years ago. So this is nothing like usual stuff, and that's why it scares a lot. In case you're interested, check out the official data from the BLS. So the Bureau of Labor Statistics gives you the possibility to download a PDF file and check out the different numbers, and you will see and will find out that there are some sort of contents from that basket of inflation data. You will see that energy prices are still a huge part of that, that food prices, that used cars and trucks prices, everything together have a huge effect on that kind of a high inflation number. check out the energy reliant stuff like heating oil, like fuel, gasoline prices. Everything went up quite heavily and have a huge impact on the whole basket of inflation data. So just to think about, in case of that kind of energy prices go down a bit, smoothed from the US government with maybe whatever some possibilities they have to reduce the pressure, it could go down. So that is something like maybe not comfy, but maybe more or less painful situation for US consumers. Let's just name it that way. Compare the 7.5% inflation on the 12-month basis in the US with a 12-month inflation data from the Eurozone around 5.3%, or the brand new CPI data from Germany. The last 12 months we had a 4.9% inflation. You see that there is still a huge difference between 7.5 and 4.9, just for same thing like 7.5, and compare that with 5.1 or 5.3% on a yearly basis. So this is a difference as well, and it has to be put into perspective as well, just because of the reason of negative yields, of negative real yields. So it's more painful in the US right now than in the Eurozone. It's nothing to celebrate. It's nothing to be happy about it. It's nothing to just shout out, yeah, we have a blast. But it's still less painful. And maybe that's the reason that we have to see something like a little bit more of a push for the euro in that case, until the first rate hikes from the Fed are coming around the corner. So that's the point. And of course, I forgot the point number 2 I spoke about in the introduction of that 3 points. The bond markets. So the bond yields between the treasuries, US treasuries, and especially the whole bond market. Look at the 2-year runners, look at the 5-year runners, look at the 10-year runners, and just compare them with a couple of huge bond markets in Europe, like you see that one with the German Bunds and with the Italian BTPs and with the French Oats, for example, and just compare that kind of yield levels to have something like a picture. And all this kind of stuff melting together is something like a combination to be seen. This kind of a news and information cocktail is, of course, just as we know that from that Dow theory, everything like information everything is melting in together, and just because of all this stuff melted together, you will be having your own conclusion. And just from the point of view right now, it looks like we have a little bit of a setback for the dollar, so that gives some room for the euro in direction of the neckline of the 115.30s neckline, back up there, and possibly we see that back down with the first rate hike in March 16, backing down in direction of the 112 in the old 111.20s we saw just a couple of weeks ago. All right. That's it for now. Hopefully we'll have a fantastic weekend. Relax, have a good party somehow. Some nice drinks, some really good and great food. And not to forget, have prosperous trades to come into the next week. Thank you very much for your time and attention, and see you next time. Bye-bye.